Mike Muller, head of Vitol in Asia, thanks for joining us again. Mike, would you agree with that we're not going to see more stability this year? And Christophe referred to the fact that how Russia may react to an escalation in the war or a response to the fact that it's losing ground. But there's also been lots of commentary in the market that Russia's control over how much it can produce and export is actually beginning to weaken. So give us a bit of a feeling there of how much Russia can continue to do what it was doing all throughout last year. Impact on prices.
Well, I'll start off by saying I'm not going to be a political commentator or a war expert here. But of course, the attention of the oil markets has focused largely on the signals coming out of Russia in the context of the price cap legislation that G7 and a bunch of other nations have introduced. And the focus now is on the comments by Deputy Prime Minister Alexander Novak about a month back now, that Russia would take about 500,000 barrels a day of production off the market. At a time, of course, when refining margins were still very good, and therefore there was initial curiosity whether this would apply to refined products, which had been subject to price cap. Of course, crude was already in a more steady state, having had a price cap introduced 2 months prior, or indeed whether this would in fact affect crude oil production. And then immediately, and we did so on this call a few months back, people start speculating whether the Russians have any technical reasons why absence of foreign technology in the subsurface exploration and production, or indeed in refining, might become a pinch point. And I think the consensus of the market was that on initial evidence, 1 year in, Russia seems pretty self-sufficient in terms of its technical capabilities. So I think there might have been some exaggerated views there. And on the strength of what we're seeing in markets, Russian oil continues to load and get on ships. The price cap discussion, of course, has created a bit of a realignment in trade flows, because the more important and more easy to understand aspect is the import ban into the EU, which sees very large quantities of Russian diesel and fuel primarily redirected to markets further afield. And it doesn't take much to figure out that that's going to tie up ships for a lot longer and longer voyages. But it's compounded by the fact that we have the spring turnaround season. So in the case of crude oil, there's a little less demand. We also see weakening in demand in Asia, in particular after the winter peak in demand. And the uncertainty over whether an original supplier of Russian origin fuel, naphtha, distillate, or indeed crude is able to give an attestation when it's been made very clear to off-takers that such attestations on price cap will not be issued by the original supplier in Russia, leaves the market with a lot of head scratching. Because it's just finish off Diallo quickly. It is obviously those parties that provide the services that have to be very vigilant: the insurance companies, the ship owners, and indeed the banks that are providing the services, that they now have to tiptoe around legislation that's been issued not by one jurisdiction but by 3 separate jurisdictions: the US, the EU, and the UK. And finding alignment there is taking the market some time.
Yeah, and I mean, you mentioned one thing that you mentioned there, Mike, was the shipping. That's one aspect of it, as you said. And for example, we've seen a lot of Russian oil going into India in the last few months, more than obviously the average does. But the one thing that apparently is standing in that continuing isn't the discount and the great deal that India is getting, but it is perhaps vessel tightness. Do you feel like that? I know that, you know, they've got the dirty tanker market out there, but will that tightness in any way interfere with the flow of Russian volumes at all, do you think, this year, with the product sanctions now compounding on top of the crude, with both of those?
There are so many factors. There's what happens every winter, which is shorter daylight hours and fog, and therefore disruptions in places like the Houston Ship Channel, in places like the Bosphorus, and in places like Panama Canal, all of which are congested or have had issues in recent weeks. Then there's the extra ton miles being consumed by Russian oil having to travel further distances. And finally, there's the extra shipping capacity that's absorbed with owners of cargoes not knowing what they can and cannot do, and their customers also not knowing whether or not they can buy. And all that is very, very clearly serving to drive up freight rates in various classes of vessel. Absolutely.
Others, Mike, would disagree that in the second half of this year, we're going to see prices rise up beyond where we're seeing them so far this quarter, and that China demand will in fact really kick in then. What's the latest from the East, from the Chinese sort of expectations? Some people tell me it's going to struggle to do that 5% GDP growth. Others are saying they're very bullish about the second half. We have a big parliamentary congress coming up for the first time in China since COVID. So what are the recent what's the recent sentiment coming from the reality on the ground, if you like, of how much pull China will bring to energy markets?
Yes, indeed. In the lead up to the Congress later this month, China has made some policy statements, and China has had some better economic news. In the weeks after Chinese New Year, the net migration figures weren't quite as strong as some had predicted they would be during Chinese New Year, because for the first time in 3 years, Chinese city workers were not told to refrain from going to visit their families in the countryside. But we have seen the beginnings of a reasonable uptick in air travel. We have to remind ourselves, though, it is still not possible to visit China as a tourist. They're not issuing tourist visas, and they're not allowing people to go on tourist trips leaving China either. So it's only open for business travel. And therefore, the vast majority of the Chinese commercial aviation fleets are still not utilized or grounded. And it is that pent-up demand that everyone's expecting will be unleashed at some point later, because there are no COVID concerns. I was fortunate to visit Shanghai just under a month ago, and we have travels planned back into China again. And I mean, the mask wearing is the same as it is here in Singapore. Of course, Shanghai is perhaps not representative of China, but there's a lot of construction, lots of cranes, even some structures that looked like they were, consuming lots and lots of concrete. So we know that the property sector is the one that was the Achilles heel in China, and had obviously had a knock-on effect to steel and all the other ingredients, cement, that go into construction in the first place. But there do seem to be some very real policy incentives for provincial governments to start building roads, construction, municipal buildings, et cetera, et cetera. The congestion was very much normal, and everyone's saying that things are busier. For example, if you go into Shanghai, before COVID, they had such a congestion problem that they had to rule out certain number plates on certain days. So when my colleagues connected me from a city outside of Shanghai, they had to come into the city the day before, because they couldn't have driven into Shanghai to pick me up in their car. So everything's back to normal in that sense. But I think this has led to a sense of optimism, as you said, Diala, in terms of the second half of this year, seeing a surge in Chinese demand, not just for jet fuel as the Chinese tourists come back and vice versa, but in terms of just a Chinese economy with full support of a pretty cash-rich central government, consuming more. And we see it in the behavior of the Chinese actors in the oil and gas space. On the gas side, there's been a severe winter drought in Yunnan, so the hydroelectric power is not there. So that would lead to more coal and LNG imports potentially. But we're seeing it in terms of reduced exports of petroleum products, in stark contrast to what we had in Q4, when there was a policy directive for Chinese refiners to crank up their runs and maximize exports, in what some people believe was an attempt to improve the trade balance at the tail end of the year. Those exports all but dried up because domestic margins were good, domestic consumption was good, and there seemed to be some desire to build inventory as opposed to putting it into the international marketplace. So China went from supplying too much oil to not supplying very much, and that gave us a rather bullish tone straight after Chinese New Year. And now the question is, what from here? It's awfully difficult to read, of course, but that just serves to illustrate that the market is justified in feeling upbeat and positive about Chinese demand growth. Most analysts seem to have been revising their estimates for Chinese oil and gas consumption up for the balance of this year, substantially so, which will make 2023 one of the biggest year-on-year demand growth stories that we've seen, with the big ones being, I think, 2009 and 2001 or 2, if I remember correctly. In one of those years, just after the turn of the millennium, China grew by 2 million barrels a day oil demand year on year. So the fear of that happening again has the bulls talking their book and suggesting that we could enter a world where spare capacity is in the hands of Russia and Saudi Arabia only. And effectively, that is base case for many people going forward into the second half of the year. And if you then look at where the spare production can come from, you look at escalating costs for producing shale liquids in the US, and people not necessarily deploying the number of drill rigs that we would have expected a few months ago.
Mike, any concerns in Asia about access to gas? Last year we had Europe sucking in a lot of the US sort of replacement gas, if you like, for Russian gas, and competing against Asian buyers on pricing. What's the feeling there in terms of, you know, assuming that we're going to see demand increasing in China, etc., and other Asian economies?
Yes, it may not be so much China as other Asian economies. I'm really glad you raised this, though, because I think gas and LNG has been taking up a lot more time in leadership team meetings in all companies in our sector than anybody ever expected it to. And of course, we have, thanks to the warm weather and the absence of demand for Russian, we've seen an overstocking and a more comfortable position in Europe, and a weakening of the price set. I mean, US Henry Hub, of course, is a landlocked index, as is TTF, but Henry Hub is below $3 and TTF is trading around $15 in MMBTU, or 47 euros per megawatt hour. At that price, LNG starts competing away the rather unusual state of affairs that we've gotten used to for more than a year now, which is that utilities burn diesel instead of LNG. So LNG is now competing again, and therefore it's going to force its way into the mix and push out a bit of diesel. And lo and behold, not just that, if it stays at these levels, you'll see entire sectors that were uncompetitive because their gas feedstock or fuel was too costly, and therefore enterprises are shutting down. Famously, large German petrochemical companies, but certainly less high-margin businesses like cement and paper and fertilizer, for example, resuming consumption in places which no longer have a high gas cost. So out in Asia now, I mentioned it's not so much China. Of course, what happened in Asia when the LNG prices went to these crazy levels is the Asians turned their back on it, or put differently, demand destruction occurred, and all the attention swung to coal. And Asia was fortunate to have plenty of coal at its disposal, and the Chinese had a couple of extra access to gas pipelines. So LNG year-on-year consumption in China was down something like 20%, which nobody would have ever seen coming. But South Asia was really where you saw the massive impact, because there it wasn't just switching fuel, it was just choosing not to have supply. So not having 24/7 supply of electricity was the norm in many South Asian economies. Those South Asian economies are back and they're buying, because to them LNG in the mid to low teens works. And that then does two things. It creates more demand for the LNG, and it creates a more global balance where there might be a redirection of Atlantic Basin LNG cargoes this way to Asia. But it also stops people burning expensive diesel. So whether that's material enough to counter the current tight diesel market and the concerns people have, plus the disruptions that I'll maintain are in place because people don't quite know how to deal with the price cap yet, hasn't yet played out. And it's always the case because markets trade a month out, and sometimes legislation comes into force in a matter of days. We had 1 day's notice on February the 4th, which was a weekend. And the EU said that they would review this every 2 months. And the next review is on March 15th, I believe. So very, very difficult to judge. But no, gas is now at a point where it's at an equilibrium level versus other fuels. And it's a very interesting market right now.
On that point, I just want to talk to you about China, Asia, so debt, again, the debt equation, if you like, that plays into that. I mean, do you see China sort of easing its monetary policy a lot? It's already corporate, private, government debt is at very high levels, as it is everywhere in the world. How careful do you think they'll be about that for the sake of boosting demand? And other people are saying the only way Chinese demand, China's economy will really perform is if its property sector recovers. So your quick point of view on those 2 points to close up. Oh, we've lost, you're on mute. Sorry, Mike.
I apologize. I think on your last point on property, it's hard to see how there could be a quick turnaround. I do think Christoph has a very valid point that China is going to introduce stimulus, but in terms of their monetary policy, it isn't really broken, and therefore I'm not sure they're going to do anything destabilizing. They seem to be on a trajectory they're happy with. Most of the world's opinion is behind China pulling through, and of course, as Christoph alluded to, China will only grow if the world will buy its produce. and therefore we don't want a recession. The Chinese don't want a recession in the rest of the world, and therefore it's in their interest to keep the cost of raw material down, and that's why perhaps we're seeing them participate in the discussions now around supply security on commodities a little bit more vocally than was the case before. But I've always on these calls been very upbeat and often criticized by Christoph for being too positive about China. It's not just because I go visit there every month. I do think China will do its bit, and if the rest of the world can stay out of recession and start consuming, and they no longer have the cost of living crisis quite as acutely as was the case a year ago, when instead of buying 2 shirts, a pair of jeans, and some toys for kids at their birthday and having a second holiday, they had to pay a more expensive gas and electricity bill. Now they can consume again. And that's a very simplistic take of mine, would hopefully rev up the engine for more containers to head across the Pacific to America and across the Indian Ocean through the Suez Canal to Europe. And then everything looks good again.